Vipul, over to yourself.
Okay, namaste and good evening to you all. Welcome to tonight's seminar on inheritance tax planning. Tonight we have Dipesh Shah, who will be presenting the inheritance tax planning and telling us what it's all about. So just a few things on Dipesh Bhai. Dipesh Bhai Shah is a wealth manager and both founder and company director of Oakdale Financial Services Limited, a partner practice of the award-winning FTSE 100 company, St. James Place Wealth Management. Dipesh has extensive experience of helping his clients plan both their and their loved ones' financial future and ensuring they are able to meet their financial objectives, thus giving them peace of mind. Dipesh Bhai has regularly presented various topics on financial planning for many years. So if anybody has any questions, please feel free to ask them at the end of the presentation or put it on the chat. And for those who want to directly speak to Dipesh Bhai, he will actually put his telephone number and email address on the chat as well. So over to yourself, Dipesh Bhai.
Hello, good evening, everyone. Thank you, Vipul Bhai, for the introduction. Hope you're all looking forward to today's presentation, which is all about inheritance tax planning, and we've called it Inherently Unfair. Now, the reason why we've used this particular title is because the Chancellor himself has said that the UK tax system is overly complicated and it's inherently unfair. So I'll give you a little bit of introduction to myself, my background. So I've been advising clients since 2005. I've got over 15 years industry experience. During that time, we've helped a lot of clients with their financial planning across various areas of financial planning. Inheritance tax has been one of the major areas. We've also helped clients across other areas of their financial planning, including making sure that they're building up funds for retirement and they're making use of the tax allowances available to them. So today's presentation, we're going to have a look at some more of those things. So yeah, I started up this company, Oakdale Financial Services, in 2011. 2011. So we've been around for more than 10 years. So that's a good thing. So just a little bit of background information about St. James Place. They started in 1991. During that time, they've become a FTSE 100 company, which is a really short time to become one of the 100 largest companies in the UK. They currently look after £148 billion worth of funds for clients. And what we provide is we provide trusted face-to-face advice. So a lot of our clients we have regular meetings with. We have regular reviews with them just to make sure that their financial planning is on track, because things will change in your circumstances, in budgets, in taxation allowances. And it's really important that we maintain close contact with our clients to make sure we continue to advise them across their journey, across all areas of their financial planning. And through St. James Place, we've got access to a wide range of products and services, which have all been checked out by St. James Place. And there is also the St. James Place Advice Guarantee, where St. James Place will guarantee the suitability of my advice. So what we're saying is we want to provide the correct advice, but just in case something has been missed out, the St. James Place Advice Guarantee will give you great peace of mind, great reassurance that if something's been done incorrectly, they'll put you back in the original position before the advice took place. So it just gives you that reassurance, that peace of mind in terms of dealing with a large company. So we'll focus on the aim of the presentation. The aim is to help you to have an understanding, or if you already have some understanding, a better understanding of inheritance tax planning. And we'll have a look at a number of steps that you could take to help mitigate the impact of inheritance tax on your wealth, on your family wealth, and ensuring that as much of this money is able to pass from generation to generation, i.e. hold on to as much of your money for as long as possible. We'll set out the objectives that we're looking to cover, which at the end of today's presentation, after going through these different slides, you'll have hopefully a really good understanding of some of the complex areas around financial planning and inheritance tax planning. Now, obviously, inheritance tax planning is a massive area, and maybe just a presentation alone might not always be sufficient, but it starts encouraging you to think about the right things. So the key things that we're looking at in terms of people have in relation to inheritance tax planning and financial planning in general, we'll have a look at these shortly. We'll have a look at some initial planning ideas that you can consider. We'll have a look at what the nil rate bands are, how much they are, how they work, what some of the rules are behind the nil rate bands. And we'll also have a look at the situation, what happens if you have assets over £2 million? We'll have a look at the inheritance tax at 64%. Yes, that's not a typing mistake. There is actually inheritance tax at 64% as well. And we'll have a look at some gifting exemptions that you can utilize on a regular basis to really ensure that you're making full use of your exemptions and your allowances. We don't like to waste any of the exemptions or allowances. We'll have a look at the importance of wills and lasting power of attorney. We'll have a look at some different types of trusts, what they are, how they work, who the key parties are that you require for a trust, and how you can use a trust to help with your inheritance tax planning. We'll also have a look at covering any liability with, for example, whole of life insurance. And then we'll have a look at a couple of other types of investments like enterprise investment schemes, business relief, and we'll finish off with question and answers. So if you have any questions, just hold on to those questions. And at the end of the presentation, hopefully going through the presentation, I will have answered some of your questions. And if I haven't, or you need some further clarification, just feel free to put it in the chat box. And then we can run through the questions and answer those questions for you. And if it's something more detailed, then it might be, we might say, drop us an email or follow up with us after the presentation. Okay. So these are some of the very, very common concerns that we hear from our clients when we're having meetings with people, just generally in our day-to-day conversations. And a lot of these concerns are very relevant to a lot of people. And you'll probably look at these concerns and think, you know, these concerns, they also apply to me. I've also got an inheritance tax problem. Or if you don't quite have an inheritance tax problem, you know that you're going to have an inheritance tax problem. And the reason why more and more people are going to have inheritance tax problems is because the allowances, the nil rate band, which we'll come on to shortly, has been frozen along with other allowances until April 2026. So the main concerns that people mention to us that we come across are the concerns around the inheritance tax. What about how much is going to the cost or the value that's going to be reduced from the estate, and the ability to pass on money assets to future generations? We all want to make sure that we're able to pass as much down as possible, with the view that each subsequent generation should be wealthier because of the work, the sort of planning that the previous generations have done. What about the fact that you have to pay 40% tax at the point of death after paying tax throughout lifetime? So if you think about it, during lifetime, we already pay a lot of taxes. So from employment, we pay income tax at different rates, 20%, 40%, 60%, 45%. We pay capital gains tax when we sell assets, property, shares. So we pay national insurance, we pay council tax, we pay VAT, stamp duty when you purchase property or you purchase shares. So unfortunately, we are one of the highest tax countries in the world. Around about 85 pence in every pound does go in tax. We want to give money away, but you also want to retain control over the capital or income, because no one knows what's going to happen in the future. Your circumstances might change drastically. So it's not always that easy to give away assets. Plus, there might be some tax liabilities. So you need to consider all of these things. You may need access to money in the future after giving it away. So what you want to do is you want to give money away, but you've got to be careful. You've got to be systematic in the way you give it away. You might not want to give it all away, because once you've given it away, there's no guarantee that the money will be available if your circumstances change. The children that you've given it to may have invested the money into a property, so the money would be tied up. It could be invested into a business. They may end up going through a divorce or bankruptcy type of situation. So we need to make sure that when we're thinking about giving any money away, that you still make sure that you've got sufficient money for yourself, because in the future, no one wants to go back and ask the children for that money. And also no guarantees is still going to be available. So you've got to look after yourself first as well. We know that 7 years you can give away the assets and survive 7 years. We know that average life expectancy is around about 85, 86. Life expectancy is increasing, but that doesn't mean that we can just wait till the age of 78 or 79 and just give it away, because life is never that straightforward. We don't know what's going to happen in the meantime. We don't know whether you would survive another 5 or 6 years from that point. So we know that 7 years could be sometimes a bit too long, because this might be because of age, ill health, medical conditions. There could be a whole range of factors why it might not be possible for you to survive 7 years. So we just got to take that into consideration. A lot of clients, a lot of people often tell us that they don't have enough time to manage their wealth and manage their inheritance tax planning, as well as keeping up to date with changes taking place. There's always a lot of changes taking place in the legislation. There's changes taking place. There's a lot of detail in the legislation. And if you're not in the field, it's very difficult to keep up to date, keep on track of everything that's going on. And you're not sure if what you're doing is sufficient to achieve your financial objectives. So unless you're clear about your financial objectives, what it is that's important, what it is that you're trying to do, then if you haven't got the objective set, you haven't got something to measure it against. So you'll never know how effective or efficient you are in terms of meeting your objectives. So let's have a look at beginning by looking at some initial planning ideas. First of all, ensuring you make use of your ISA allowance. Now, at the moment, we're right in the middle of the ISA tax year-end season, which ends on the 5th of April. I did a presentation about a month ago to the HCB on tax year-end planning. Now, at this time of the year, you probably get bombarded with a lot of messages on TV, a lot of paperwork that might come to you in the post about making sure you use up your ISA allowance, your end of year allowance. Now, it's worth pointing out that ISAs are great from a point of view that they're capital gains tax free, they're they're capital gains tax free, they're income tax free from income tax as well. So any investment in an ISA can grow tax efficiently from income tax and from capital gains tax. You've also got two different types: a cash ISA, which is probably earning at the moment the best interest rate is about 0.67%, and you've got an investment ISA, and the limit that you can put into ISAs is £20,000. So by all means, you should certainly try and make use of your ISA allowance where possible each year. But one thing to point out that often doesn't get pointed out, ISAs themselves are not inheritance tax friendly. So usually what happens is, with money in an ISA, when you pass away, that's added onto your estate from an inheritance tax point of view. So if you think about it, if you've got £100,000 sitting in an ISA, then let's say, for example, it's a cash ISA, you're getting let's be generous. Let's say you're getting 1%, right? That means you're getting £1,000 interest on your ISA, but because it's in an ISA, it's not friendly, it's not inheritance tax suitable. So that means £40,000 on your £100,000 is going to get wiped out because the ISA is still part of your estate. So clearly, we can see that it doesn't add up. It doesn't make financial sense to have all of this money in an ISA earning 0.6% or 1%, call it 1%, and then at the end of the day, you're losing 40%. That doesn't make any sense. And we come across scenarios like this all the time where clients have the money just stuck in cash ISA because they're afraid of investing it in the right way. They think that they need access to that amount of liquidity. Yes, it's important to have a balance in terms of how much liquidity you need, but leaving all of your money in a cash ISA or maybe even in an investment ISA might not be the best thing for you to do with your money with regards to inheritance tax planning. You should certainly consider maximizing contributions to your pensions. So when we're saying putting contributions into your pensions, this is a great way to save inheritance tax because any money held within a pension is free from inheritance tax. It's also free from inheritance tax straight away. There's no need to wait 7 years. There's none of those type of scenarios. And the good thing with pensions is you can put in 100% of your earnings. So at the moment, the current annual allowance is £40,000. So you can put in £40,000 into your pension, providing you have the earnings. Now, that's a good amount. Plus, if you've got higher earnings and you haven't utilized your pension allowances, you can actually go back to the 2018-2019 tax year. So you have to do the current year first, which is 21-22 tax year. Then you go to 18-19. And then if you've still got earnings and you've still got some more money left over, you can put some money into 19-20 tax year or 19-20 or 20-21 tax year as well. Now, bear in mind, once we come to the 6th of April, the new tax year will be 2022 to 2023. So a 2018-19 tax year will drop off. So this is the opportunity to put money in for that. Now, that's where, so pensions is great, whether you're employed or whether you're running a business. If you're running a business, a limited company, you might pay yourself a small amount of salary, take the rest, you're taking the rest as dividends. The rest of the money is left in your company. If you put it into a pension, again, that's going to be outside of your estate from an inheritance tax point of view. So certainly worthwhile putting in money into pensions. Now, one thing you have to be aware of is with pensions, it's linked to your earnings. So if you've got rental income, if your sole source of income is rental income, then that's not really earnings. Earnings has to be earnings from employment. That's what we're looking at. So if you only got rental income, then you may not be able to put in as much to a pension. And what we say to clients, we have a lot of clients in the 60s, they're still working, mortgage is paid off, kids have grown up, they don't need the money. So what we say to them is put that money into a pension, you get all the tax reliefs on the pension, plus it's outside of the estate, plus you still got access to the money if you need it. So pensions have become super attractive because of the changes that have taken place in pension freedoms, which mean now a lot of clients will use pension money as a way of giving money away for getting it out of the estate, but they still got access to it. So it's a really powerful tool. You should make contributions to ISA, junior ISA for children or grandchildren. So these are similar to the adult ISAs. You can do a cash ISA, you can do an investment ISA. You got a limit, 9,000 odd pounds that you can put in there. And if you're looking at investing this money, it's a good way of offloading money from your estate by putting it into children's ISAs or grandchildren's ISAs, and it's helping them to build up a lump sum for the future. So that's really good. You can consider taking advantage of your capital gains tax allowances. So what we're talking about here is minimizing the impact of capital gains tax. And the way we do this is, for example, if you're thinking about selling an asset, and it's just in one person's name, i.e. the husband or just the wife, because that's how it was, then one of the things you should consider before you sell the property is to put it into joint names. That way, you can utilize 2 lots of capital gains tax allowances, 12,300. So that's really attractive. You can sell some assets this tax year before the 5th of April, and you could sell some more assets on the 7th of April or 6th of April. So what you're doing is you're splitting the sale of assets over 2 different tax years. Again, that's a really good way of doing it, because you'll get a new capital gains tax allowance of 12,300. The other thing that you can do is, if you're a higher rate taxpayer and you know in the future, in the next few years, you're going to become a basic rate taxpayer, or you're already a basic rate taxpayer and you're going to become a nil rate taxpayer, then one of the things you could do is consider deferring the sale of the asset until your tax position changes. And that will help to also bring your capital gains tax exposure, your capital gains tax bill down. So again, means more money in your pocket. Make use of small gifts or gifts from income to reduce inheritance tax. So we'll have a look at that shortly. You should take advantage of interspouse transfers to maximize allowances. So between husband and wife, as long as a will has been made, a correct will, then there won't be inheritance tax on the first death. Using annual inheritance tax gift allowances for this year and next year. So we'll have a look at that. Right, let's have a look at this nil rate band. I've said that it's currently £325,000 for an individual. For a couple, husband and wife, the allowance is currently £650,000. So we know that these allowances that I've mentioned so far, they're all going to be frozen until April 2026, as confirmed by Rishi Sunak, the Chancellor. So what that means is, more people, if the inheritance tax levels are frozen for a long time, that means that more people are going to get caught by the inheritance tax, by the fact that asset prices will continue to increase. More people will go over those boundaries, and therefore more people will be liable for inheritance tax. We'll have a look at the main residence nil rate band. So this is in addition to the nil rate bands that we've just mentioned on the previous page. This main residence nil rate band applies if you have a main residence, or if you had a main residence and you sold it previously. Okay. So in terms of for an individual, it's 175,000, and for couples, it's 350,000 pounds. So if you add these figures, if you're a single person, single or divorced, then your allowance, providing you qualify for the main residence nil rate band, is going to be 500,000 pounds. If you're a couple or you're widowed, then your allowance is going to be the £1 million, 650 plus the 350,000 pounds. Now this will apply to one property that has been your main residence at some point, but executors are able to nominate. So this is where you've had more than one main residence. You're normally going to nominate the one with the highest value. It has to. One of the requirements for the main residence nil rate band is that it must go on death to direct descendants. So this would include, for example, a child, a step, adopted or fostered child of the deceased, and their lineal descendants. So sometimes we've come across scenarios where the main residence is going into a trust, and if that trust has not been set up correctly with the correct wording, then it's going to have a significant impact, in the sense that you're going to lose. You could end up losing, by having the incorrect wording, you could end up losing this valuable allowance of the main residence nil rate by 175 or 350k. And if you ended up losing that £350,000 allowance, that means you're going to pay an extra £140,000. So if you've got a if you've got some sort of trust and the property, you need to make sure it's been set up correctly. These allowances, they're all transferable. So let's say, for example, the first spouse passed away 10 years ago. At that time, there was no main residence nil rate ban, but the surviving spouse will still be entitled to it. Now, this only applies to married couples where the allowance is transferable. If you're an unmarried couple, from an inheritance tax point of view, it might be a good idea to get married. So total nil rate bans. For the current tax year, we said for an individual, it's £500,000, and for a couple, it's £1 million. We'll now have a look at this scenario where assets are over £2 million and some additional care and planning that's required for these types of scenarios. Now, here we're talking about net asset value after taking into account the value of the mortgages. One thing to be aware of is, although you may not be at the £2 million point at this moment in time, you have to think of what your age is. You have to base it on the average life expectancy, which is around about 85, 86. 85, 86 is the average life expectancy. And you have to bear in mind that asset prices, because of factors like supply and demand, also inflation, asset prices have risen steadily over the number of years. And over the next 10, 15, 20, 30, 40 years, whatever, we would expect asset prices to continue to increase and be higher than they are now. So although you might not be at the £2 million now, you have to think further forwards, because this is a big problem that a lot of people will get caught out by. So what happens here is, where you've got an estate over £2 million, this is a special rule for estates over £2 million. What happens is, the main residence nil rate ban is reduced by £1 for every £2 above £2 million. This means if your estate is worth 2.2 million, because you're £200,000 over, you will lose £100,000 of main residence nil rate ban. So that main residence nil rate ban, which I said for a couple is 350, will now come down to £250,000. And that means that your total allowance will now have gone down from £1 million to from £1 million down to £900,000. What it also means is, because you've lost £100,000 of your allowance, it's going to cost you an extra £40,000 in tax. Now, if your assets are above 2.7 million, then what will happen? Because of this rule, you will lose the £350,000. The main residence nil rate band is the maximum you can lose. You will always have the nil rate band of 650 for a couple. But if your assets are worth 2.7 million, i.e. £700,000, you're going to lose the £350,000 allowance. Your allowance will now come down from £1 million to 650. Anything over 650 will be taxed at 40%. Just by losing this allowance, £350,000 means you're going to end up losing £140,000 in inheritance tax. So we'll now have a look at the next situation. So in this scenario, the question we're asking is, will your family pay inheritance tax at 64% in just 3 generations? So what we've done here, the table illustrates if inheritance tax was paid on the transfer of assets between just 3 generations. So we talk about the grandparents, their children, which we'll call them the parents, and their children, which we'll call the grandchildren. Okay. So in this scenario, what happens is, as assets pass by subsequent generations, this figure could rise further. So between the first generation, so this is the grandparents, they've got assets over the nil rate band, which is worth assets of £1 million. We know that if they pass away, when they pass away, there's going to be inheritance tax due of £400,000. So this means that to the second generation, i.e. their children, we're going to have a net value going to them of £600,000. Now, assuming this second generation pass away after 5 years, then there's going to be a further inheritance tax of £240,000, because we're assuming that every generation already has assets up to the £1 million allowance. Okay, so a further £240,000 has gone. So that means that the third generation, which is the grandchildren, they're going to receive a figure of £360,000 or 36%. This means that £640,000 or 64%, the biggest beneficiary has been the HMRC. Not the family, but the majority of the money has gone to the HMRC. There is something called quick succession relief. Now, this applies where the next generation passes away within 5 years of the previous generation. Now, a lot of times, there usually is at least 5 years between the deaths. If it's five years and one week, then the quick succession relief will not apply, and the tax will be based on 100% of. There won't be any reduction in the tax payable. So what we're saying is, if we go back to the previous slide, we've seen the problems of over £2 million, where allowances get reduced, tax increases. We've seen the impact of inheritance tax on subsequent generations. And if we do this further into the future, into the fourth generation, assuming that these generations haven't done any other planning on top, then the problem is getting compounded. The problem is getting worse. Now, the government also give you some gifting exemptions that you can make use of, and certainly you should make use of them. But we have to bear in mind that these numbers are very small because they were done a long time ago. They haven't been updated for many years. These numbers, which I'll run through them, you're allowed to give away small gifts of £250 per person. So if you wanted to give it to all your friends, you could give a small gift of £250 and you immediately save £100. You can give annual gifts of £3,000. So this is per individual making the gifts. If the husband and wife are making the gift, between them they can give away £6,000. It's not related to how many children you're giving it to. This is your gift. So this is your allowance of £3,000. Whether you split it between one child and give them £3,000, or you split it between 3 children and give them £1,000, the fact is your allowance that you're allowed to give away to reduce your inheritance tax is £3,000. For a couple, it's £6,000. You're allowed to give away wedding gifts in respect of children or grandchildren getting married. So they're allowed to give away up to £5,000. But one of the key requirements is that the gift must be made before the civil marriage ceremony. It has to be made in advance of the ceremony. And again, that can help save up to £2,000. Then you've got regular gifts from income. So this is where you have surplus disposable income each month, each year. And the revenue are perfectly happy with you giving this money away, as it doesn't have an impact on your standard of living, because this is surplus income. You're giving away your income. So let's say, for example, simple example, you have £6,000 coming in per month. Your average cost of living is £4,000 per month. That means you've got £2,000 left over. £2,000, okay? Now, assuming this £2,000, if you give it away as it arises, then because you're giving away your surplus income, which is different to giving away capital, then it's going to be immediately outside of your estate. There's no need to wait for the 7 years. So really a powerful tool that is. Then what you've got is the scenario where you've got let's say you've got 4,000 coming in. If you're spending 4,000 and then you're giving away £2,000 per month, that in this scenario you're giving away your capital. So the revenue will not like that. So when you're giving away your capital, you then the 7-year rules come in after the annual gift exemption of £3,000 has been used up. So we need to be very careful, very clear on the differentiation, the distinction between income and capital. They're both very, very different. And of course, you can make gifts to registered charities and get a reduction on the taxable value of the estate. Now, what we will say with these numbers, of course, these numbers are very small. So based on these numbers, it will probably take forever to make any sort of meaningful impact, any sort of meaningful headway into your estate planning. So what we're saying is you're going to have to give away larger figures to help reduce the value of the estate. So just a quick summary so far. £3,000 is a single person's annual exemption that they're allowed to give away, which was immediately exempt from your estate. If you're married or in a civil partnership, that figure is £6,000. Now, if you haven't done anything for the previous tax year, then you can also utilize these allowances. You can go back the previous year and you've got another £6,000. So right now, if you haven't done anything for last year, you could do last year plus this year. Husband and wife could give away £12,000 using joint carry forward, and that's immediately outside of your estate. So again, that's going to be powerful. Consider gifting options and uses. So for example, one of the things you could consider is a junior ISA contribution for children. That helps to get the money out of your estate. It also helps to build up the money in the children's ISA. You could also put money into a pension for grandchildren, stroke children. The annual amount the amount you could put for £3,600. So if you make a net contribution of £2,880, then the government will put in 720, bringing the figure up to 3,600. So it's a nice way of using your annual exemption, £3,000. The numbers match up. It allows you to offload some money from your estate. It allows you to benefit from inheritance tax savings. Plus, your children, stroke grandchildren will benefit from upfront tax relief. Plus, the money is invested. Plus, over a long period of time, you got growth plus compounding. So that's a powerful tax efficient way of passing on this money. Obviously, if your earnings are higher, like we said, you can put the money into your personal pension, utilize as much of your earnings as possible, and then when you pass away, that can go to your children, grandchildren as well. So this now brings us on to inheritance tax gifts, the 7-year rule. So a lot of people believe that once you give the gift away, the 7-year rule starts working straight away. It doesn't quite work like that. What happens is, let's say you haven't made any gifts so far, and right now you give away £100,000. Now that £100,000, if you die within 7 years, that's treated as a failed gift because you haven't survived 7 years. So what that means is your inheritance tax allowance will reduce by 100,000 from 325 to 225,000 pounds. Now, where the 7-year rule comes in, this tapering relief. Let's say, for example, you've given away up to the nil rate band, which is 325,000 pounds, and you give away some more money, another 100,000 pounds on top of that. Then if you pass away in the first 3 years, then unfortunately there wouldn't be any inheritance tax saving on the additional 100,000 pounds. The inheritance tax will still be payable at 40%. And then it reduces on an annual basis. If you were to survive between 3 and 4 years, you'd pay £32,000. If you survive between 4 and 5 years, you'd pay 24%. If you survive 7 or more years from the time of making this gift above the nil rate band, then the allowance will be the tax that you will end up paying will be zero. So what we would say is, if you're thinking about these larger gifts, it's important to try and do them sooner rather than later. The sooner you do them, the better it's going to be, because if you do it younger, then you're going to benefit from more 7-year cycles where you can get multiple 650s out from your estate, and you've got a lot better chance of surviving 7 years. The longer you leave it, the less flexibility you have and less certainty that you will survive 7 years. So we'll now have a look at trust and estate planning, and this is where we're going to make use of gifting during your lifetime. Now, if we go back a couple of slides, I just mentioned recently that the numbers have not been updated for a long time by the government. So those allowances are quite small. We need to look at bigger gifting. we spoke about the problem where the assets were above £2 million. So by making a gift of something above £2 million, you're then coming closer or back down to £2 million. So that's massively tax advantageous. And I also gave you the scenario of the 3 generations where you end up paying 64% tax by the time the 3rd generation passes away. Now, if you use the trust, then it means that those subsequent generations don't end up paying such an expensive rate of inheritance tax. So you should certainly consider giving away during your lifetime, whatever surplus assets you have, surplus income that you think you're really not going to need, then you should start thinking about giving that money away. Like I said at the beginning, you might not want to give it all away all at the same time, because you don't know what's going to happen, your health, you don't know how long you're going to live, and you don't know what your circumstances will be. So you need to make sure that you've got enough for yourself. But anything surplus, certainly you should be giving it away. You need to make sure that you've done wills, you've set up wills correctly, you've considered power of attorney, which is if you lose mental capacity due to accident or illness, you want someone else to be able to come in, step in and make decisions on your behalf. Now, sometimes it may not always be possible to give away all the assets because, like we said, you might need them, but also when you're trying to offload these assets, there may be severe tax cost, i.e. you might have to pay capital gains tax, heavy rates of capital gains tax, depending on when you purchase the asset. You might want to keep hold of the asset as part of your long-term security. So therefore, you might not be able to sell it or transfer it or give it away. So what you might do in that scenario is make sure that you cover any liability with a whole of life policy. And we'll have a look at how this works shortly. So cost of life assurance. Cost of life assurance does not need to be expensive. In this example, we look at a joint whole of life policy based on a second death and a value of £100,000. Now, joint life second death whole of life policy means it's written on both people. The policy will pay out when the second person passes away, and because it's whole of life, there's no end date to this particular policy. Now, we're assuming that they're in good health and that they're non-smokers. If you're age 45 and the premium, if you're both 45, then the premium is going to be £97.12 roughly. Now that means that you would need to live to 130 before the amount you've paid in is greater than the sum assured. If you're 55, then the premium is going to be more expensive, so that's going to be £138 because the risk is higher. But your life expectancy, if you live beyond 115, you're going to end up paying more. 65 again is a bit more expensive, and even if you haven't done it or you've left it a little bit late, and you're 75, you think, okay, I'm still in good health. You can do it, but it's going to cost you more. It would be cheaper usually to have done it at the age of 45 for 40 years rather than paying these heavy premiums at the age of 75, usually, because the premium will be a lot higher, assuming that in both cases they die at the age of around about 85, 86. We have to use the same age. Now, what some people also do with this whole of life policy, this joint life second death whole of life policy, is one, they use it because they don't want to sell the asset. They want to enjoy the rental income from property or whatever it is. They want to hold on to it. So in order to hold on to it, they'll use the profits from that surplus income and use that to pay for a whole of life policy, which will then cover your inheritance tax. What you can also do, we've done it for clients, is where clients want to leave some money for their children. They've got 2 children and they want to leave them £100,000. Maybe they haven't got so much in terms of assets, but they want to leave them some money in the future when they pass away. And the whole of life is a great way because there's no investment risk. You know what the premiums are from the beginning. The value does not go up and down. You can calculate how much you would have paid in. Obviously, you need to bear in mind that the value of £100,000 in the future is not the same as £100,000 today because of the cost of inflation, the real value of money goes down as inflation increases. So what is a trust? A trust is a legal arrangement. It allows a third party, so the third party is the trustee. They hold assets on behalf of the beneficiaries. Now, the trustee and the beneficiaries can be the same. It's a great way of using a trust to pass wealth from generation to generation. So trusts have been around for a long time, and a lot of generations have said, look, these are our surplus assets. Let's pass them into a trust. We survive 7 years, and then that money, there's no subsequent tax. Whereas the example I gave you, if the money doesn't go into a trust, then after 3 generations, 64% has been wiped out of the value. So you can use it to arrange your tax, your estate tax efficiently. And the key thing is, with a trust, it allows you to keep control. So as a trustee, you always have control. If the original trustees have gone, you can appoint new trustees, and the trustees will have to make a decision about what the trust was set up for and what the money is for. So if the beneficiaries come to you and say, we want to buy a yellow sports car, you have to think, the people that set up the original trust, was that the intention? If you think that was not the intention when the trust was being set up, then you wouldn't hand over the money, because ultimately the trustees will decide. Now, the great thing about putting assets into a trust is that it's free from any situation like divorce or bankruptcy. The money in a trust is going to be protected. Now, of course, if you are aware of a situation like a divorce or bankruptcy, and you put the money into a trust just to try and get around it, then clearly that's not going to work, because the trustees will be the trustees of, if there's any divorce case taking place, or if there's any bankruptcy, the trustees will have a look at what you've done, and they'll say you've done it deliberately to deprive the asset. So you've got to be careful that there isn't any scenario like that taking place. So now we're going to have a look at some different types of trust plans that we can use. So the first one is the gift plan. This is where any gifts that you make will be outside of your estate for inheritance tax purposes, providing you survive 7 years. The good thing is, if you're using your annual allowances, the £3,000 that I've mentioned so far, then the good thing is that can be immediately outside of your estate for inheritance tax purposes, because it's one of your exemptions. Any growth or any profit in the investment is immediately outside of your estate for inheritance tax purposes. So let's say you put in £100,000. The £100,000 after 7 years is going to be outside of your estate. You save £40,000. Let's say that £100,000 in 7 years, the profit is, let's call it 50%, £50,000. Then that £50,000 is also going to be outside of your estate. The key thing is, with the growth, because it belongs to the trust, that money, the growth, the profit, is going to be outside of your estate from day one. So that's one of the great things about putting the money into a trust. Withdrawals within the allowance may be provided without immediate liability to income tax. So this is where the settlers, the people that set up the trust, they can't benefit from the withdrawals, but the beneficiaries can benefit from withdrawals. And we provide all the trust documentation. So we do a lot of these gift plans. St. James's Place already have paperwork approved by HMRC as part of the service we provide. We ensure when we do an investment into trust, we also create the trust, set it up. So what we're trying to do is we're trying to keep paperwork down to a minimum. So the key thing is, with this, it allows you to make use of inheritance tax exemptions and reliefs. So I've mentioned that you've got a £650,000 allowance at the nil rate band for a couple. Now, if you put that into a trust and you survive 7 years, then after 7 years, you'll get a new allowance of £650,000. So for a couple, every 7 years, you could give away £650,000. So the earlier you start, the better it's going to be. You can use this money, the parents, or certainly the grandparents, can use this money to create a fund to pay for school, university fees for their children, grandchildren. And often with the way university fees are, they've been becoming more and more expensive. It's a good way of getting money out of your estate to reduce your inheritance tax liability, plus providing the money for your beneficiaries to be able to fund their education. So certainly really, really helpful way of doing that. It allows the proceeds of the gift plan can be received by your beneficiaries at the time they need it. Because it's in a trust, there's no need to wait for the full probate. So that's good. And then where it's a discretionary trust is used, funds in the trust will not form part of the beneficiary's estate. So the previous problem I mentioned of the 3 generations, 64%, that problem will not apply if you're putting the money into a trust, because even if the second and third generations passed away, then they're not all paying that high rate of tax. So the other thing to mention with all of these trusts is the fact that the paperwork is really simple. It keeps the paperwork down to a minimum. There's no annual self-assessment or self-declaration to do. There's no reporting on an annual basis, so it keeps it simple, keeps it straightforward. Then we've got another type of plan, which is called a discounted gift plan. This is where you're looking to give away capital, but you need an income to cover your expenses, your standard of living. Now, usually when you make an investment or when you give something away, you can't get any benefit back, because that would be treated as a gift with reservation, and you'd be breaking the allowances, or breaking the rules. So what happens here is, with the discounted gift plan, this is the way the documents have been set up, the trust documents. So this is all approved, allowed by HMRC. So the key thing is that there's an immediate reduction in your potential inheritance tax liability where you're eligible. It provides what we call an income, and it's income in brackets or speech marks. So what we're saying is, it's really although it's called an income, it's really treated from a taxation point of view as a return of capital. Because it's a return of capital, that means you don't need to put it on your self-assessment, because it's not income in that sense. The income that is provided, or the return of capital, so you get an immediate tax liability. So it will be provided without any immediate tax liability, and you're allowed to put in a certain amount into this discounted gift plan. And providing you, so what will happen is, part of it you'll get an immediate saving on your inheritance tax. So that's really good. You'll get this return of capital. So it allows you to do inheritance tax planning, but keep hold of income if you need it to maintain your cost of living. So useful where you're asset rich and maybe cash poor. And it allows you, the other part will be outside of the estate after 7 years. So after 7 years, the whole amount will be outside of the estate for inheritance tax purposes. Also, any future growth will also be outside of the estate, because it belongs to the trust. And we'll have a look at the potential immediate tax savings on the next table. So this example, this table looks at a case where we're putting in £250,000. You're taking 4% withdrawal per annum, so that's giving you £10,000 per annum. Now, the earlier you do this gift plan, the better the discount. So if you do it at the age of 60, then the value of the discount is 138,000. This is based on a HMRC formula. This £138,000 is going to be immediately outside of your estate. This will save you 55,200. As you become older, if you're 70 years old, or let's say you're 65, you're getting a discount of almost 50% of this 250,000. So £124,000 will be outside of your estate straight away, saving you nearly. If you're a little bit later, you can still do it, because this product is designed where people have an inheritance tax problem and they need income at the same time. Okay. And then we have what's called a loan plan. So what this is saying, look, I can't afford to give up my capital of £100,000, I don't want to give up my capital of £100,000 and take a fixed income of up to 4% per annum. What we're saying is here, we need flexibility. So what we're saying in this scenario is I need access to my capital. I need to be able to take it out, but I don't mind giving away the growth or the profit in the plan because I don't need it. So we'll give it to a trust. And the idea is that over time, you're spending money outside of the estate. Any money you put into a loan plan is still in your estate until you take it out, spend it. But what it allows you to do is it allows you for that money to grow. Growth belongs to the trust. And then you're able to take back your capital that you put in over a number of years. It's designed to potentially reduce your inheritance tax liability. It provides you full access, total flexibility, full access to your capital, just in case your circumstances change. And if your circumstances change in a way that you don't need access to this money in the future, then one of the things you can do is you can look at it allows you to use this plan to change it into one of the previous plans that I've mentioned so far. The benefits, investment growth is outside of your estate. You can recall the loan at any time. So if your circumstances change and you need all of the money, you can recall the money. And there is no inheritance tax payable on establishing the trust. And then there's a number of different things that you can do. So it allows you to get regular repayments. You can supplement your income if it's required. And it provides a flexible platform for other IHT planning, like I've just mentioned so far. Other solutions that we can consider would be, for example, these solutions may be suitable where the 7-year planning might not work because you might not think you're going to survive 7 years because of age or medical health. It might be suitable where you can't get life cover because your health is really bad or your age, or you just don't have the affordability for the life cover. So we have to look at other options, other ways of doing your planning. So good thing with, there's a number of tax advantages for enterprise investment schemes. Now, I will point out that these are high risk investments because they're investing in smaller type companies, startup companies, and it may not be suitable for everyone. However, if you're putting in a small proportion of your total overall wealth, then it may be suitable for some people. Now, you get income tax relief of 30% may be claimed back through the enterprise investment scheme. So to get this allowance, this tax relief, you must have paid the tax in the first place. You can't get back more tax than you paid in. This is also good where, for example, pension contributions is not available because you don't meet the definition of earnings, but you've got rental income, then you can use rental income and get 30% back on enterprise investment scheme. It allows you to defer the capital gains tax. So you're not getting out of it. It just means you're deferring it till later on. When you eventually sell the asset, that's when you pay the capital gains tax. And if you pass away, then capital gains tax gets wiped out. So it's a way of deferring it. So you could keep deferring the capital gains tax. There's also inheritance tax savings after 3 years. It qualifies for inheritance tax savings. So again, that's going to be a good thing. So you have to look at the risk involved. You have to look at the different taxation benefits. There's huge benefits, and you have to consider it in relation to your overall portfolio and whether this type of planning is going to be suitable. But like I said, there's other types of planning that you could consider. This is in addition. We're now having a look at business relief. So business relief is where you invest in small, unlisted, unquoted companies. This could include companies on the AIM market. You have to hold the investment for 2 years to qualify. You also need to hold the investment at the point of death. Now, the good thing with business relief, if it's done between a husband and wife, if it's set up together, the first person passes away after 1 year, then it doesn't mean that the second person needs to hold the investment for 2 years. It will carry on until, so if the first person passed away after 1 year, as long as the second person survives at least 1 more year, then it's going to be outside of the estate from inheritance tax point of view. So the risk on business relief type planning is lower. What this table shows you, The blue bars are the enterprise investment scheme, and the grey bars are the business relief. So what we're seeing is, as you get older, it's more the blue bars are in relation to holding a product for 7 years. So you can see by the time you're getting to 75, 80, the chances of surviving 7 years and it being effective are reducing. Whereas because this business relief product, you only need to hold it for a period of 2 years, you can see that even at 85 or even at the age of 90, you've still got a fairly good chance of surviving 2 years. So again, it's just another type of planning that could be considered in addition to the other strategies that I've mentioned so far. So here we are looking at 2 scenarios, and this is around main residence property planning, which is always a difficult area to plan. So what we often hear at client meetings, clients often tell us this is, I could just give away my residential property, I can carry on living in the property, and my inheritance tax planning is solved. The answer to that is no, that would be incorrect, and the revenue would never make it that easy. Because if you did it, everyone would do that. You wouldn't need to come to this presentation, this webinar, because it'd be so nice and straightforward, and the revenue would never do that. So there's a couple of scenarios we need to be aware of. The first situation is you give the property away and the children live with you. Now this is absolutely fine, providing you split the running cost of the house in the proportion of the share that you've given away. Now that might be good and well to give the property to the children. You all live together, but that doesn't mean that's always going to be the case. The children might get older, they might get married, they might change their mind. Maybe they can't live with their parents, for whatever reason. There could be a number of reasons. Okay, so what happens in that scenario where the children have moved away? We'll come on to that shortly. But in the other second scenario is where you give the property away, the children don't live with you, so you continue to live in the property. In this case, you've got to pay a market share of the rent. So if you give away 50% to the property of your property to your children, then you're going to need to pay 50% of the market value of that property. You can't do a family rate, a discounted rate, a lower rate. It has to be a commercial rate for that type of property. So those are the 2 scenarios. If the children live with you and they're going to live with you forever, then that's totally fine. You split the expenses, you have to survive 7 years, that works. The other scenario is the children don't live with you, and then you just pay them rent. And because they're receiving rental income, it's going to be taxable like any other rental income. So it's quite difficult to do that. Now, sometimes you get a scenario where you start off with scenario 1, you've given the children are living with you, but in the future they decide not to live with you. Now, if the children decide not to live with you, then the scenario 2 will come in. You'll need to start paying them market rate of rent. And when you give the shares to the property, you've got to be aware that if they go through any situation like a divorce or bankruptcy, then because it's an asset held in their name, that's then going to be liable for tax. So in terms of inheritance tax, we'll have a look at a summary of your options that are available. So we've talked about a lot of different types of ways of planning, but it's really can be broken down into 4 main areas. The first one is put money into a trust and make use of the allowances that I've mentioned so far. You could certainly use whole of life cover to cover the liability, because you're going to be certain that the whole of life policy will cover you for as long as you live. That's one scenario, using whole of life cover. Another scenario could be, you could consider, if the premium for whole of life is too expensive, you could look at a policy to age 90. By doing it to age 90, it means it gives you time to sort things out. It means you can give everything away by age 83, and then you still got the life policy in place. So you're not having to give things away straight away. You're getting to keep the control of the asset. You probably get to enjoy the income, the rental income, for longer, and you've got another asset for your longer term security. So that's good. And the other thing you can do with life cover if you're doing these 7-year gifts, you could do life cover just for 7 years, keep the cost down, and that's a good way of covering the gifts that you've made to be 100% certain to be bought in braces. That's the way to do it. Then you could consider, for example, these tax efficient investments that I mentioned, like, for example, business relief, enterprise, investment schemes, those sort of things. And the fourth option, which I think is actually probably the hardest option out of all of them, spend or give all your money away. Because one, you're not just going to spend your money, give it away. You're not just going to spend it for the sake of spending your money. Two, how much money are you really going to be able to spend? And three, remember your assets. For example, your main residence, your buy-to-let properties, your shares, your other investments. A lot of these things are also going to increase in value over time, because asset classes do increase over time. So it's actually pretty difficult to try and spend all of your money. So we're now coming on to the summary. So we're coming up to the end of the presentation. So we said that we would look at all of these areas. So we spoke about the concerns that people have in relation to inheritance tax, i.e. the amount of tax that needs to be paid, the fact that we've paid tax during our lifetime so far, the fact that you may need access to it, your circumstances might change, you might not be able to get it back. There's a whole range of things, plus people don't have time to do their planning. So those are common concerns that we come across, and the solutions that I've provided, it's often a case of using a combination of different solutions to make sure that we're able to achieve your investment, your inheritance tax objectives as efficiently and effectively as possible. We talked about some initial planning ideas. So ISAs, they're good from a capital gains income tax, but no good generally from a inheritance tax point of view. Got to be careful of cash ISAs. The rates are low. You'll end up paying 40% on the value of the cash ISA because it'll be added to the estate. We spoke about pensions, and they're really attractive way of putting money in. And we talked about junior ISAs as well, junior ISAs, pensions for children, grandchildren. So there's a number of different things that you can do. The more things you do, the better your planning will be. We talked about nil rate bands, 325, 650 for a couple, and we talked about the main residence nil rate band. So for a couple, it's £1 million. We spoke about what happens to assets over £2 million, the impact it has on the main residence nil rate band, and how it reduces your main residence nil rate band for every £2 you're above the £2 million figure. So again, we need to do some planning, even if you're not quite there, or if you're there or you're not quite there, we still need to do some planning, because the inheritance tax is payable at the point when you pass away. So the value of the asset will continue to increase. I made you aware of the inheritance tax at 64%. It's a big problem. It's very common for multiple generations to end up paying tax because they're all passing away after 5 years from the previous generation. We talked about the gifting exemption. So some of the numbers, we talked about annual gift allowance, £3,000, small gift, £250, gifts in respect of marriage. We spoke about gifts from your regular surplus income, absolutely fine. We should try and utilize those exemptions as much as possible. We talked about how the 7-year rule works in terms of it doesn't start straight away. It only applies once you've given away assets up to the nil rate band of £325,000. We looked at the importance of wills. If you haven't got a will, you should consider getting a will. If you've got a will where your property, something to do with your property is going into a trust, you need to check the wording, because if the wording is not correct, it could be a costly oversight or costly mistake, because those wills that you might have created might have been before the rules took place, the new rules that took place in 2017. So if you've got the old wills, you need to just review it. Power of attorney, we say to all our clients, make sure you get this done. Really important to have in place, just in case something happens. This is all about making sure we're mitigating all the different types of risks and protecting you from these different types of scenarios. We talked about trust plans. Key thing is that there's different types of trust plans that we can utilize. The growth is outside of your estate. and paperwork, we try and keep it down to a minimum, because there's no annual self-assessment or self-declaration to do on these types of trusts. We talked about whole of life and that the premiums don't need to be too expensive. Certainly, it's a great way of covering the liability. Sometimes it's not always possible to give away the assets because of taxation, or just purely you might need hold of that asset for your long-term security. So we could consider a whole of life policy. Then we talked about other investments, enterprise investment schemes. We talked about business relief, which are slightly higher risk, not suitable for everyone, but can be very efficient as part of a combined strategy to dealing with inheritance tax. And we talked about main residence property planning. So that brings me to the end of the presentation. Thank you for taking the time this evening to listen to the presentation. Hopefully it's helped you with regards to your understanding, your knowledge of inheritance tax, the sort of things that you can do that will help you to reduce the impact of inheritance tax, because ultimately we want to make sure that as much of this money stays within your family and you're able to pass it from generation to generation. So that's really important. So we're now open for questions. I've put my contact details there. My telephone number and my email is also there. And if you need to find me, Financial Services, easy to find. So yeah, any questions, happy to go through any questions. And if the question's a little bit sensitive or you don't feel comfortable asking in the group audience, feel free to drop me an email and I'll come back to you on that.
Thank you, Divesh, for that. Any questions from anybody? If you have a question, then please unmute yourself and then ask your question. Narendraji, I think you want to ask a question.
That was very good detailed presentation by Dipesh sir, and I congratulate him. Very clear presentation. My full name, Dr. Narendra Kumar, and I'm a retired NHS consultant. The couple of things, you mentioned the importance of setting up a correct type of trust. So I would like to know a bit more in detail later on. I know it's already 9:15, and maybe probably I will email you or phone you. And the other one, giving money into junior ISAs for the grandchildren. So whatever money we give away in junior ISAs, will that help me reducing my tax burden? Will I get any tax relief on that amount?
So what will happen is, if you're putting money into junior ISA, you can use up your annual gift allowance of £3,000. You can use up your surplus income. So because you're using up the exemptions, this money is going to fall outside of your estate straight away. So you're getting a benefit there. Plus the children or the grandchildren will benefit because the money is invested in a tax efficient wrapper. You would invest it for capital growth over the long term. And then you've got capital growth plus taxation, tax that you're saving, plus the value of compounding. The longer you leave the investment, the more powerful the compounding will become. So yeah, absolutely important. If you've got, let's say, for example, 3 grandchildren, you can do a pension for all 3 grandchildren. You can help with the junior ISAs. There's various things that you can do which will help to start bringing your estate value down.
That's great.
Thank you.
Thank you, Dipesh. Okay, got some questions in the chat. Okay, so the first one is, what is the running cost for the trust and how much does it cost?
So the trust doesn't have any running cost itself because the cost is to do with the investment. So when we do the investment bond into the trust, we set up the trust. There's no running cost of the trust. There's no annual declaration or self-assessments. There's no tax returns or tax. There's no trust tax accounts or trust returns that you have to do on an annual basis.
That's great. Thank you, Dipesh. The next question is, which is better, limited company or trust?
Which is better, limited or trust? That's a detailed question, like asking what's better, an apple or a pear. Now they're both good, but it depends on your circumstances, what you're trying to do. So, for example, where you've got multiple properties, more than six different properties, 7 properties, then you may consider putting it into a limited company. Now, there's a process that you need to follow in terms of incorporation. It needs to go into a partnership. A couple of years later, it can go to a limited company. Limited companies obviously will benefit from corporation tax that you pay at 19%, compared to if the property is in your personal name, you could, whether you need the income or not, you could end up paying 40 or 45% on that income. So company is good. You can take out, you can take the money out as dividends, the income, how much you need, so you can control the amount of tax that you pay. You can also use the company then to make pension contributions, because the company can do pension contributions. And then later on, if you've built up your pension, or you've built up your other assets, then you're in a position where you could give away shares in the limited company. So that's a tax efficient way where you get to enjoy some of the benefits still. And if you put it into a trust, then you're giving up the ownership of if you're putting the properties into a trust, you can defer the capital gains tax on these buy-to-let properties. So that's a good thing, because you get holdover relief. You get you're able to take the money out where you've got beneficiaries and use up their personal allowance, which is 12,570. So it's not a straightforward question of one is definitely better than the other, because it depends on your situation. It depends on your levels of taxation that you're paying. It also depends on ultimately what you want. Whether you want to just give away the property and not have any income, and that's a trust. That could be a trust option. Or if you need the income, then it might be a case of giving it into a company. But for that, you need to have held probably six properties, existing properties. However, if you're thinking about buying a new property, and you only got one or two properties, then you might consider just buying that new one in a limited company, because at least you're not getting hit by all the capital gains from that point of view. So it's one of those that would need detailed exploration of the.
Okay, thank you, Dipesh, because that was my question about the limited company and trust, and I think you've answered it really well. My question, I mean, it is really about 2 properties. So if you've got 2 properties and a main residential property, would it be better if you've got less properties than the 6 or 7 to put it into a trust, or would it be better?
So the 6 or 7 properties relates to there's a HMRC ruling, Ramsey case. The Ramsey case is to do with transferring those companies, and it's a detailed thing. But if you've got 1, 2, or less than 6 properties,
Yeah.
what you do, what we're talking about is, if you put it into a trust, then the income does not belong to you. Income belongs to a trust. So you've got to be comfortable that you've got enough income. That might be a solution to put the property into a trust, but you've then got to be sure that you're not going to need it. So one solution might be to put one property in now and the other one later on. Remember, you've got £650,000 of net asset value that can go into a trust. So let's say, for example, the property is £650,000 and you've got no mortgage on it, and that can go into the trust. If there's 2 people, there's a couple. You've got full 650. But let's say the property is worth £800,000 and you have a mortgage, or you get a mortgage of £150,000, then that whole property could go into a trust, because that's a 650,000 over 2 people. So that's fine. And then after 7 years, you might decide to put the other one in. So it might be put one in now, put one in later on. Conversely, there might be two small ones, both £300,000 flats, and you might decide to put both in at the same time. So that would be £60,000. So you do have choices, but it also depends on whether you've got enough income from other sources. If you have, that could be an option. Or you could look at some of the other options that I've mentioned so far, which could be, rather than putting it into a trust and deferring the CGT, you could consider, for example, looking at the life policy. So you could put it into a trust and take a 7-year life policy to protect the gift in case you die within 7 years. Or you could look at the other policies up to age 90 or on a whole of life basis and keep the properties, as that's going to be your long-term income. It could be your long-term security. So it's certainly a question that deserves a more analysis and understanding. But hopefully that gives you
really
a flavour.
helpful. No, it's really helpful, because I don't think many people know that if you've got properties, you've got the option of taking up a life policy. Because I think many people's understanding, and it'll help everybody who's listening, is and mine, the understanding was that whole of life policies where you just pay into a policy, like an insurance policy. But I didn't know that we could use properties as assets to take out whole of life policy or a life policy up to a certain age as you retire. And in my case, I'm 60, so I think it's really important for us to understand, the different.
Absolutely, and the key point is you've got to know all the options that are available to you, and that's what we try and do. We try and cover the different scenarios for your particular set of situation, but try and make it relevant to you. I try and keep it simple without overcomplicating it with lots of fancy complicated terminology, jargon. I try and keep it as straightforward and as understandable as possible. But if the properties is what's giving you the problem from a inheritance tax point of view, then you could say, why not just use some of that income that's coming in the properties to pay for the whole of life? So that way you've still got the properties, you've still got the income, you've got the security, you've got the whole of life. You're starting to do other bits of planning. It might be that you don't end up putting into a trust.
Great. Thank you so much, Dipesh Bhai. I'll definitely be in touch with you.
Brilliant. No, more than happy for anyone who wants to contact me. More than happy to help anyone with any questions, anything that they're thinking, really.
Great.
Thank you, Dipesh. I've got Harshad Bhai Solanki. You raised your hand, so do you want to ask your question?
Yeah, actually, it's Raksha. So
Hi,
thank
Raksha.
you. Namaste and thank you. It's a brilliant, extremely informative discussion. So thank you. My question is that if we were to put our money into a trust, and imagine if one of us needed to go into a home to be looked after, does it have any implications at all?
If you do it today and you're going into a care home next week or next month, and everybody knows you're going into a care home, then that's not going to work, because they'll say that you've done it deliberately, you've done it on purpose. But let's say at the moment you're fit, you're healthy, you don't have any medical problems, no one really expects you to go into a home. If it happens, it might be 10 years down the line or 5 years down the line. Then putting it into a trust is great, because any money.
How I scare my neighbors with my.
Any money which is in a trust does not belong to you, so therefore it's not going to be accessible against care home situation. So if it's done well in advance, then yes, that's absolutely fine. If you do it today and you know tomorrow you're going into a care home, then they're happy. The local council, they'll say you've done it on purpose.
Okay, thanks. So are there any risk factors for the trust?
Depends what you mean by risk factors. Depends what you're trying to do as well. If you're trying to save inheritance tax, then the trust will work. The money is outside, although it's not intended as a form of planning for care home. It's making sure that the money is not available because of the way the bond is written. What else is there? The other thing is that not always do people go into a care home. It depends on the level of or the severity of your health. A lot of people nowadays prefer, rather than going into, obviously if your health is really bad and you've got no one to look after you, can't manage, then you might have to go into a care home. But in a lot of cases, a lot of scenarios, a lot of people, what they do is they bring carers in to look after them, to provide some services like help you get up, move you, help you move around the house, help you shower, clean, eat, whatever. So sometimes people have carers that come in and they help them from that point of view. So people don't always end up in a care home.
Thanks,
Okay, thanks. Thank you.
Okay. Okay, question from the chat then. This one is, I'm paying university fees for my children. Can I get tax exemption for the fees paid?
You get tax exemption? No. At the end of the day, you're paying the fees for education. The only tax relief, the only thing there is obviously you're spending the money. So you're getting the money outside of your estate. So if something happened to you yesterday, then whatever you spent is not in your estate.
Great, thanks for that. Next question.
But yeah, good investment. Otherwise,
I'll just ask a quick question. Just they say like the pensions are ring fenced. Are the trusts ring fenced as well? Are they?
How you mean ring fenced? They're ring fenced from creditors, trustees. In the situation of divorce or bankruptcy, yes, then that money is going to be ring-fenced unless you've done it deliberately to deprive them. So if there's a situation taking place, a divorce or bankruptcy next week, and you do it today, then they're going to say, look, you've done it deliberately on purpose. If you in advance, then yeah, it's ring-fenced. This is one of the major reasons why people use trust, to protect the asset, to have control over it.
Right, okay, that was that. And the second one I'll just quickly ask as well. So if a parent gives the child a property, but they still want to have control of it just for the future, can you have a power of attorney over it so your kids cannot sell the property whilst you're alive, or some sort of endorsements or something like that in it?
So power of attorney only comes into play if you lose mental capacity due to accident. You're just not able to make any sort of decisions. You've lost mental power, mental capacity. That's what a power of attorney does. It allows people to make decisions on your behalf. So if you're thinking that type of power of attorney that we're talking about here.
Not that type of, like sometimes you have a legal power of attorney, not just because you're incapacitated or some sort of, you've got some mental illness. If you cannot make it, or you want somebody else to make the decisions while you're away, or you've got some other you've got some other agendas to do, so they can act on your behalf. You can get a power of attorney, but that's more of a legal question in terms of that. But if you can get a legal document, then so you're saying. So it's more security for the parents. Like if in the future I give something to my kids, I still want to safeguard myself and make sure, if I'm living in a house and I pass it on to my kids, they don't say, look, we're selling the house now, we're moving to something smaller, find something for yourself. I still want to have control over my house, etc., and my properties whilst I am alive.
Yeah, I think the problem you'll find with that is once you've gifted it, you don't actually have any control. If you want control, the way you have to gift it is by a trust. So you would be a trustee. They can't sell the property without your say-so. But if you've given it to them, then they are entitled to do whatever they want with it, because otherwise that would be like a situation of like having your cake and eating it.
Yeah. Okay. That's fine. And you can set whatever amount you want on when you pay yourself from a trust. Is that correct?
So you don't necessarily pay yourself because when you put the asset into a trust, the idea is that you shouldn't benefit because you're doing it for inheritance tax purposes.
Yeah, you're not benefiting, is you're running costs for your living, etc.
Oh yeah, the running costs you would subtract them off, correct, before you get to the profit.
Yeah, so there's no tax implications on it personally, and well, the trust is not going to be taxable, is it?
Sorry, what's that?
So personally, you'll be liable for tax, or the trust will be liable for tax, or there's no tax involved at all?
The trustees will be liable for the tax. It depends on the tax rates of the beneficiaries.
Right. Okay, that's fine.
Okay, more questions. The next one is, you mentioned that putting money into pension was a good way of reducing the tax. How would this work?
So let's say, for example, you put in £8,000 into a pension. If you're a basic rate taxpayer, you'll get £2,000 back from the government. So you've got £10,000. If you're a 40 taxpayer or high rate taxpayer, if you put in £8,000, you'll get £2,000 straight away from the government. Plus, you'll claim back another £2,000 through your self-assessment. So it'll cost you £6,000, but you'll get £10,000 in your pension. And then also the key thing is, when you put money into a pension, it's 100% outside of your estate from a inheritance tax point of view. So with a pension, you're getting the tax release from the government. You're getting the money outside of your estate. You've still got access to the money. The money can go to your spouse, and after you or your spouse have passed away, the money can go to your children. It can keep getting passed on from generation to generation.
Great, thanks for that. The next question, I'll read it out, okay? So we have a SPV for property, and is it best for parents to invest in this for the inheritance versus trust?
If you're the owner of the SPV, then the limited company is still going to be part of your assets. So yeah, the SPV will still, if you're the owner, the shareholder, then that's still going to be part of your estate. So putting it into trust will reduce the value of the estate. If you can put the limited company, the SPV, into a trust, then that's something that could be done. But again, you'd have to seek specialist advice on that before you follow that course of action. But yeah, SPV into a trust, that should be fine.
Okay, there's a follow-on bit to that. So this is to take advantage of the business relief that you mentioned.
Yeah, business relief, but property does not qualify for business relief.
Okay, great.
So if your limited company is only it buys a property, it renovates it, and then holds on to it for rental income, that is not going to be qualifying for business relief. Property is not. If your business is buying and selling properties, you're trading properties, then that type of business will qualify for business relief.
Okay, great, thanks. The next one is, do you have to pay capital gains tax when you put rented properties into trust?
Do you have to pay capital when you put rental properties into trust? So what happens is, when you put the asset into the trust, it allows you to defer the capital gains tax. Now, obviously, at some point, the trust will come to an end. The property will need to get sold. And when the property gets sold, the capital gains tax will be based on the original purchase price. So let's say, for example, you bought it for 100. The value when you put it into a trust is 250. And later on in the future, let's say 100 years down the line, you sell it for £1 million. Then it will be £1 million minus the original cost, which was £100,000. And then the tax will be based on that, which you will pay for from the proceeds of the property. So all you're doing is deferring it until later on in the future.
Right. Okay, we've got no more questions. I'm mindful about the time as well. So one last stand for anybody to ask a question before we bring the session to a closure.
Sorry, yes, Naresh, just elaborating on the pension side of things. You said we can pass it on to our siblings, or sorry, to our children and grandchildren, but the wrapper that the pension is in stays as a pension, correct?
Correct. You would pass it using dependence drawdown, so it will always stay within a pension.
So when I leave, when I pass away, whatever's left in my pension, I give it to my son, but that would add to his existing pension lifetime allowance.
It's going to be separate to his lifetime allowance because it's inherited funds.
Oh, okay. So it doesn't affect that at all. So when can he withdraw that money then?
He can so as a dependence drawdown, they can draw the money out. If they take the money out as income, they pay income tax at their marginal rate. If they take it out as tax free, then there's no tax. They can take it out at any time.
So he doesn't have to wait till he's 65 or 60, whatever, 55 or whatever.
No, because it's the inherited pension.
Okay, cool. Thank you.
That's great. Any final questions? No. Okay then, Jazz, I'm going to hand it over to yourself for the close down before we bring the session to a closure.
Right. First of all, thank everybody for attending today, and special thanks to Dipesh. Definitely an insight. I thought I knew quite a lot, but it's given me more of an insight and a lot more to think about and look into my future. Well, everybody's future really. But so definitely, thank you very much for this. And also, you know, we'll definitely pass on the details of yourself down to everybody who's watching. If you could share that spreadsheet with us, we can at least pass it on to the people who are here today, if that's possible. So they've got something to digest, if that's okay with yourself.
Which spreadsheet?
No, the presentation. Sorry, the presentation, not the spreadsheet. The presentation.
Oh, so presentation. It would have been on the recording, right? As
That's correct.
Yeah,
yes.
That's correct. Yeah. Okay, so one or the on that one, that should be fine as well. So again, thank you very much, and thank you everybody else for attending today. The next session will be soon. We'll keep you posted on that. And also just want to say, till next time, at least as always, take care of yourself and each other, guys. You know, it's one of those times. So thank you very much, everybody, for attending, and let's put it to a close.
Yeah. Okay. Just one last point then. So as Dipesh has mentioned, this is a recorded session, so you can watch this again back on the YouTube channel. Just search for the Hindu Council Birmingham, subscribe to that, and then you'll be able to see the re-recordings. Or you can go to the website, hcb.org.uk, and then you'll be able to see it on the website as well. With that note, thank you, everybody. Have a pleasant evening, what's left of it, and we'll see you soon. Thanks, everyone.
Cheers,
Thanks.
Bye.
yes, thank you, HCB, for organising.
Yeah,
that's great. No, thanks a lot for that, Dipesh.
See you all at the Holi.
Yes, Holi next week. So please make time and effort to go there.
See you. Bye-bye.
Bye now.
Bye.
Thank you. Bye.
Bye now.
Hi, Dipesh bhai.
Hello, Jasmine, how are you?
Good, thanks.
Good.
Hi.
Good. Well, nice.
Good night, everyone.